Good evening, ladies and gentlemen. What an absolute privilege and pleasure it is to be here to join you all for the concluding series of this 30-year journey in memory of Shri Lalit Doshi. I feel particularly privileged to be having this conversation with someone that I've respected and admired and spoken to over the past 2 decades. Just to take forward what we heard there from Mr. Doshi, Mr. Kamath, of course, as we've heard many times over, has been the perennial India bull. He's been a champion of the India story, but I got to witness that personally in the early 2000s. We started a program in association with ICICI Bank on CNBC-TV18. It was called the Emerging India Awards. The idea was really to create a community and a platform for India's emerging entrepreneurs, for India's SMEs. And I remember way back in, I think it was 2005, 2006, Mr. Kamath said, India is not enough. We need to take these stories global. And we decided to take the Emerging India Awards, which, by the way, then became India's largest SME property. It has made it to the Limca World of Book Records as well. And we took the Emerging Awards to London to start with and to many other international destinations because he firmly believed that India's time had arrived and it was a story to be told globally. So I completely agree with you on his ability to take bold decisions and to be ahead of the curve. I know he's also a big believer in technology, and again, something that he has championed through the course of his career. And he's also been a champion of gender parity and diversity, and that I'm truly grateful for, Mr. Kamath. If we could tap into the brain power present here in this room, starting, of course, with Mr. Kamath on the stage, but also luminaries here in the audience, Mr. Deepak Parekh, Mr. Uday Kotak, Mr. Ganguly, Mr. Nambiar, Mr. Mahindra, Dr. Anisha, we would have the most appropriate and impactful blueprint for India at 100. And what a fitting tribute to Lalit Doshi to have all of these luminaries here in the audience to conclude this 30-year journey. But without further ado, Mr. Kamath, let me start by talking to you a little bit about the past, because as they say, you need to have a glimpse into the past to be able to connect the dots in the future. As we look at where we stand today, what have been the most seminal, the most transformative changes that have brought us to this pass that you believe we will need to amplify and build on as we look at India at 100?
Yeah, clearly 1990 is where set the, I would say, ball in motion with the opening up of the economy. It took the Indian entrepreneur probably 8 to 10 years to come to terms with it. And then certain other things happened. Interest rates in around 2000, the government bond was at around 11.5%. So you wanted a home loan, you probably had to borrow it at 15%. A car loan was 18% and a motorcycle loan was 24%. We could not have gone ahead with those rates. I think at that point in time, the government addressed this. I think Vijay Kelkar was the finance secretary. And within a year, actually rates came down to the bond rate. The 10-year government bond came to around 6 or 6.5%. And then suddenly everything became got into motion. I think the mortgage dropped to around 8.5%, car loans 10.5%, and the motorcycle was available at the interest rate of 14%. I think that set in motion one cycle. The second cycle is that drop in interest rate also helped corporates to clean up their balance sheets and the banks to lend a helping hand, and along with certain key steps taken by the Reserve Bank. I remember Dr. Jalan was the governor. He brought in we had a dialogue, and he had a dialogue with all of us, bank CEOs, and he introduced the idea of restructuring of credits which could be restructured. If it could not be, then of course you let it let it die, as it were. But most of the companies could be restructured. But so there was a restructured book and an NPA book. But with the drop in interest rates, and I would say a newfound competitiveness, the effect of opening up could be seen from 2000 onwards, when you saw the growth rates propel, along with certain other policies. So that opening up then rose through the 2000-2008 period. 2008-2009 is, I would think, the next step, when you had infrastructure come in. And lot has been said about infrastructure, but I think we also need to factor in, it was a learning process for everybody, including if you see the rapidity with policy changed, policy reversed. So you, as a lender, somebody else as an entrepreneur, and the consumer, all were caught in this whirlpool. I won't go into the details, but we can map the number of policy changes that took place for a variety of reasons. So we had to face that challenge, but then that challenge got addressed starting 2014, and you had a new momentum come in. So I break this into the opening up in the early 1990s, then 2000, 2008, 2009, a period of rapid growth. Then slight, I would say, the economy stalled as it were, and then it took off again thereafter. And during this period, 2-3 things have happened. Just to put this into perspective, technology changed. So if you look at the banking business, the induction of technology took place in the late 1996. Thereafter, it remained more or less stable. And then you had cloud, and now you have open source. So the technology movement is going on. Along with that, you had corporate India embracing technology. And to me, the most exciting part of this journey has been post, let's say, 2018 or so, 2019, the start of what I call digital India. Probably as of now, 150,000 digital startups, which will be a major part of 75 to 100. We'll talk about it when you catalyze that process, as it were. But to me, that is where the technology, we will become a digital society, and you will have transformation. Corporate leaders have already transformed. The layman has transformed. The person who could not use a phone today is using an app. And digital India will drive the future. So there are these 3 or 4 phases. And of course, with all this, you have what I call intelligent AI. We'll discuss that again if you catalyze the process.
Well, let me start by talking to you about the prescription and the roadmap as far as the financial services sector is concerned, because that is a sector that you know best. And let me start by talking to you about the role that you believe Indian banks will play as we move forward, and what you foresee now as the future is concerned for the banking sector. Do you believe we have too few banks? Do you believe we need more banks? Do you believe there should be more competition? Should the Reserve Bank be giving more licenses out? What is the view that you have as we look at the next 25?
See, the way I look at it is very simple. Again, I use global examples as to what will happen. The banking sector, the financial sector, if you look at in our context, you got the banks, you got NBFCs, you got fintech players who want to be banks, who want to be players in the system, intermediaries in the system, and you got the capital market. So I would think that the next few years is where the capital market will start to actually propel at a faster rate than the other sectors. For the reason that this type of savings that get into the capital market are happening at a faster rate today.
Yeah.
Whether it's pensions, with insurance, and so on and so forth. The type of instruments that the capital market can can bring to the market. The market can, for example, we look at long-term instruments, which are appropriate for corporate India, but the banking sector tries to provide long-term money by term transformation. You'll take your average maturity is 1 year. You then try to transform it into 8 or 9 years. That's inefficient. So you have the capital market able to provide that maturity, because that's the demand on that other side, the other side of the table. Then you got an efficient system. So this will happen over time. It won't happen tomorrow. So the retail sector will be primarily catered to by the banks. Banks will be still deposit-taking institutions. I think in the middle will be the NBFCs and fintechs, who will try to pump in technology at a probably faster rate than banks. So banks will have to do catching up. And it's good for everyone, because there will be more competition, there will be greater this. But ultimately, as far as the banking sector is concerned, this is purely my perspective. You'll have banks which will bulk up. And if you look at globally, including whether it is finally China, it's 15-year experience. You will need for an economy which goes from 4 trillion to 8 trillion. I look at ourselves as an 8 trillion in the next 5 to 6 years. You will need very large banks. The size of banks that we have today will have to expand dramatically. The good news is Indian banks now are running an ROE of upwards of 15%. So they are, to me, almost like a perpetual cycle engine, which doesn't need external funding, because the question would have been, yeah, they need to bulk up, but where is the capital? This capital need is very large. But I see Indian banks running 15 to 20% ROE. That's good enough to grow at a healthy rate and meet the size of bulking up. Because every 5 years, or what is it, at 20% every 3.5 years, they will virtually double.
So, on the question of bulking up, do you also see consolidation as being a possible road to bulking up and getting that world-sized bank that we've been aspiring for?
This is, I would think that it happens. It just happens by itself. Nobody needs to actually get to drive that this is the way you go. It happens. Business leaders understand what is the next imperative, and they'll take that step. And I'm sure at that time the policymakers also will say this is for the good of the country and support it in whatever means, either growing organically or through a process of mergers. Bulking will happen.
Speaking about regulation and regulation keeping pace with innovation, and specifically as far as the banking sector is concerned, two questions as we look at the next 25 years. Do you believe that regulation should allow a fintech, for instance, to be able to get a banking license? I mean, the founders of Zerodha in their conversation with me said, we want to be a bank. If we could apply for a banking license, we would do it, tomorrow. Do you believe that should be something that we consider as we go forward? And two, allowing corporates into the banking sector. This has been much debated, much talked about, much asked for as well. Do you believe that the time has come to perhaps consider that possibility?
We need to understand this whole question from the perspective of the regulator. A regulator's primary purpose on the banking front is safety of deposits. So when the regulator feels that there is comfort in fintech or digitech coming in and becoming a bank and taking deposits, for which finally the Reserve Bank or the regulator is going to be responsible for. At that point of time, they will allow this to happen. So clearly, it's a transitionary process. So as that confidence builds up, that change will happen.
Well, what does your gut tell you? I mean, if you were to take that call today,
I think,
on the back of what you are seeing,
to be very frank, it needs a little more time, because I am seeing signs of rash behavior. I'm being very frank about it on the part of digitally driven enterprises, which I think the regulator has had to manage with great care. And if you look at it as a bank, as a banker, if a regulator says that on, say, retail unsecured lending, I have to increase risk weightage by 25 bips, to me it is a signal. Or if another regulator says that 90-95% of F&O transactions are basically where people have lost money, and maybe 60 entities on the other side have made money, and that this funding has come from where? It has come from somewhere within the financial system. Then I think they are not amber flags; they are red flags all over the place. So the regulator has to be careful. I think in the context of corporates, I think there was a different view that was there. These things that I mentioned will be relevant, but also is there going to be what I'd call lending to self, and how to go ahead. So I think the regulator has to be comfortable with these things before he proceed. But to me, the first step is bulking up of existing players.
Is there room for privatization of banks over the next 25 years? Do you believe that there is political will or political capital, even though we've got the legislation, in place? Do you believe that there is political will or political capital?
I don't want to go down the route at all. What I'll say is, if public sector banks are going to run an ROE of 15 to 20%, they should thrive. So why should there need to privatize them? Give them more freedom, but make sure that your ROE is 15 to 20%. To me, that is the holy grail.